Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Businessweek Daily. That is Carol Massar. I'm Tim Stenivek. A story that we're following closely, and it's a Bloomberg exclusive, actually. Bloomberg obtaining exclusive details of private discussions between European and Russian diplomats. European diplomats warning the Kremlin that NATO is ready to respond to further violations of its airspace with full force, including by shooting down Russian planes. Russian officials have denied their planes crossed into Estonian airspace and insisted that they are not trying to test NATO, saying Russian military flights are guided by international rules. I want to bring in Becca Wasser, Becca's defense lead for Bloomberg Economics. She joins us from our Washington, D.C. bureau. Becca, what would it mean if NATO would respond in this way? I mean, isn't that the entire point of NATO, to respond collectively if there is such an incursion?
Thanks so much for having me today. I think you're exactly right. NATO's core focus is for the alliance to essentially treat an attack on one to be an attack on all. What we are seeing here is not necessarily an attack, but rather incursions that violate sovereign airspace. And so what we are having is a collective response. It's just not necessarily taking overt military means. What I think we have seen today with this scoop that Bloomberg News had is a warning from NATO and NATO allies to communicate that should Russia continue to violate NATO airspace, there may be repercussions for those actions. A core part of deterrence, which is what NATO is all about, is trying to communicate to someone that their actions have consequences. And I think that's exactly what these NATO allies have done today. And they're trying to make it so that there isn't a potential escalation or any accident that could spiral further and lead Russia and NATO into conflict.
So, U.S., part of NATO? I mean, so I am curious. We have certainly seen from President Trump saying that Kyiv and Ukraine can win and that they're in a position to fight and win back. Specifically, to be fair, the president's gone kind of back and forth in terms of his support of Ukraine or also support of Russian President Vladimir Putin. So is the U.S. all in on this and supportive of NATO, all in 100%?
So the U.S. is a founding member of NATO and therefore has said that they are all in and that they will ensure the security of NATO and the NATO alliance. That said, if you are looking at President Trump's comments, he makes it very clear that he sees NATO likely to be a European project. So while the U.S. is part of NATO and has reaffirmed many of its collective commitments, there is this emphasis on European nations doing more. And within that, the idea that the rest of the alliance, now that they are spending 5% of GDP on defense, are going to be able to step up and take on the lion's share of the burden. And I think we've already seen that in the initial response to these airspace violations. NATO has stood up Operation Eastern Sentry in order to deter any further incursions, and the U.S. has not contributed additional forces or equipment to that. We're also seeing something very similar play out as it relates to President Trump's comments about Kyiv being able to fight Russia and take back territory that it had previously lost during Russia's invasion of Ukraine.
Yeah, that was a surprising development this week.
Absolutely. I think fundamentally what it really means is that there is no change on the ground if the U.S. were not to step up its military aid. And we don't see any indications right now that the U.S. is planning to do so. What is happening is that the U.S. is willing to provide weapons, but through NATO, and only if other NATO allies will pay for those weapons to be sent on to Ukraine. So absent any change in the provision of military aid, both equipment, additional intelligence support, and potentially taking some of the training wheels off of long-range strike capabilities, there probably isn't going to be the ability of Ukraine to be able to take back that territory.
Hey, listen, Becca, one of the things we want to ask you, you're our defense lead for Bloomberg Economics. You led studies in war games for the U.S. Department of Defense at the Center for a New American Security in the RAND Corporation. What can you, we're switching gears a little bit, but there is a story that has definitely popped up high on the Bloomberg terminal, and it has to do with the Defense Secretary, Pete Hegseth, summoning top military commanders for a meeting early next week. He apparently has not talked about what this meeting is about. What do we know? What are we hearing? How unusual is this?
I think you've hit the nail on the head. It's quite unusual. This is something where no one really knows exactly why everyone has been called back to Washington, D.C., why they're all going to be meeting at once. I can't think of a single moment in military history where every single general was located in the same room as the Secretary of Defense and senior leadership.
What does this mean? How many generals are out there, and are they been pulled from posts around the globe? Like, what are we talking about? Size and scope here.
We are talking about hundreds of people. So we are talking about some of the senior leaders in the Army, the Air Force, the Navy, so every military service. We are talking about the folks who are currently leading operations overseas. We are talking about people who are based at NATO, at European Command, at Central Command. We're talking about everyone coming from all over the globe to meet in one place all at once.
Wait,
this is truly unprecedented.
I have to ask, so who's watching everything?
Well, the good news is that the U.S. military is highly well-trained and highly capable, and there's going to be a lot of command staffs that are going to be doing a great job holding down the fort wherever it is that they are. So there is going to be oversight, but what won't be there is some of that guidance that you have from some of your top leadership and your top military officials to ensure that things are going according to plan and according to the guidance set forth by the Secretary of Defense and the Department of War.
Perhaps it's a question about organization and what Pete Hegseth, the Secretary of Defense, wants the military to look like. Just in the last 30 seconds that we have with you, we know he's made some changes at the top. He's fired some longstanding members of the military. He's done some reorganization. How would you characterize the image that he wants to portray?
The Secretary of Defense has been very clear about what his priorities are and how he wishes to remake the U.S. military in that image. One of his top priorities has been, in his words, lethality. But lethality has not been well defined. Some people think that it focuses on capability. Others tend to think that it focuses on military readiness, as well as the way in which the U.S. military presents itself. Ultimately, I think the Secretary is the only one who knows truly what he means, and perhaps maybe this meeting is an opportunity for him to communicate that more broadly.
All right, interesting stuff. Becca Wasser, thanks so much. Defense lead for Bloomberg Economics, joining us from our DC bureau.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to stay on the tech world because we did have some headlines involving TikTok.
Yeah, Oracle, Silver Lake, and MGX will be the main investors in TikTok. This according to CNBC's David Faber. He reported this on air. He cited people familiar with the matter. Oracle, Silver Lake, and MGX will have a combined 45% ownership of TikTok. That's according to Faber. Looking at shares of Oracle right now, Carol, down about 5.8%.
All right, we're talking TikTok. We just talked about a possible Intel-Apple kind of tie up there with our Mark Gurman. We want to stay again on really the tech world and even that tie-up or possible tie-up. We've got the head of a company that's one of the world's biggest sellers of the chips at the heart of mobile phones, including Apple, which is its second biggest customer, at least according to Bloomberg data. Great to have with us Cristiano Amon. He is CEO and president of Qualcomm. He joins us from the Snapdragon Summit in Maui, Hawaii, along with our BTech co-host, Ed Ludlow, which you can find on BTV every day at 11 a.m. Wall Street time. Ed out there in our San Francisco bureau. Gentlemen, great to have you both here on Bloomberg Businessweek Daily. Cristiano, I want to start with you. I got to ask you, Apple is, according to our data, your second biggest customer. What would a possible Apple-Intel tie-up mean to you guys?
Look, there's no relationship. And actually, it has been widely reported for years now that over the next few years, I think Apple will stop getting chips from Qualcomm. And the company has really moved on not only what we're doing within the Android ecosystem, but we're now in PCs, in automotive, in industrial, in robots. We're even into the data center. So Qualcomm, it's a different company right now. We continue to execute on this strategy, and there's really no relationship.
But in terms of a tie-up, do you think that's even something likely, that there is some deeper relationship between those two companies?
The way I think about it, and like, I don't know details, but I can only see two possible angles. One possible angle is Intel continue to invest to become a foundry. In that case, as we are a fabless company, we welcome more foundries. Today, we manufacture our chips with TSMC, with Samsung, and if Intel has the capability to become a competitive foundry in America, we're very happy, and we will look at them as a manufacturer. As far from a product standpoint, I can't really see a connection because Apple have their own processors.
And we want to get on to other stuff. One more question, though. How are you feeling about the government investing in Intel? I don't know, would it be fair for other companies, even a Qualcomm, to say, wait, what about us? Look,
my understanding of this is there is an overarching strategic topic, which is manufacturing of semiconductors. And I think we know, and it's been widely reported, that Intel had a struggle to compete with companies like TSMC and Samsung. So anything that is driven towards enhancing the industry manufacturing capability, especially in the United States or even other places, so we have a more geographically diversified manufacturing, that's actually good news. We're looking at the big picture.
Cristiano, the thing definitively that's changed is the landscape in both PC and mobile. But I really want to start on the PC bit. I look at what's come out of Maui, generation to generation from a year ago. And what's really clear is you want to push even deeper into Windows-based PC. Could you just explain how the generational updates on the tech help you do that and why it's important?
Yes, and I wish you all here with us. This is actually not bad place.
We wish we were there also.
Yes, this has been day 3 of a lot of announcements, all the chip announcements. And one thing that we're actually very proud. I think, as I said, earlier to Carol, I think the company is diversifying. We're building products for many different industries, and PCs is one of the growth vectors of the company. So we announced our second generation PC. We just entered this market, and in our second generation, I think people are seeing one of the biggest leaps in performance from generation to generation. We have 40% improvement in the CPU, 80% improvement in the GPU, and we actually have the very first processor in a thin and light laptop running at 5 gigahertz of clock frequency. But the real news is the amount of AI performance. I think the transition of phones and PCs to AI is happening, and those chips are designed to do.
Cristiano, I don't want to make statements because I'm the journalist, and as you know, I love to ask you questions, but I go very deep on what's happening. And so there's an acceptance that this is edge technology that's deployed in the real world. But I kind of want to hold you to how it's going. In February, you basically said that in really specific category, Windows PC priced $800 and above. I think you said you had 10% market share in that. And I'm looking at the specifics of what came out of Maui in the last 3 days. Do you have an update on the ownership you have in that market, or what this latest gen of chipsets will do to push you deeper into it?
Yes, this is a great question. We are, as we're new in this market, and it has been, it's actually, we can leverage a lot of technology. It's actually accretive, I think, to Qualcomm. And we're tracking to what we said. We actually only launched this, you see PCs with our chips in the United States in the top 5 European markets, and we're tracking about 9% right now. I think our projection was by 2029 to get to about 12%, very reasonable. But what is exciting right now, and that's, I think, in your question, is the edge AI transition is happening. Actually, the foundational models now are being designed so they have cloud and edge working side by side. And that is actually creating an opportunity for us to accelerate. And it is reflected in a number of designs. We actually, a while ago, just a couple quarters ago, we talked about having 100 designs across all the major PC OEMs, HP, Dell, Lenovo, Acer, ASUS, Samsung. Now that number is significantly higher, and we're seeing the excitement.
To Carol's question, I think it's fair, like the NVIDIA Intel product collaboration puts this emphasis back on x86 against ARM-based chips. How are you tracking the penetration of both in the market? If you're going to react to that NVIDIA and Intel deal and how it changes the market, you must also be tracking it in that context, how you are pushing into that territory.
Yes, when you actually, and I'm gonna quote to you when you just said, when you actually dig deeper on it, and it was interesting actually when that announcement happened. It was interesting. We were slightly up. It was kind of neutral to positive to Qualcomm, and we saw, I think, the market stock reaction on ARM, on AMD, and then Intel was up. And the way we actually look at this, we're incredibly excited. Because what it basically means is, I think it's Intel sending a message that their integrated GPU and their AI products are, they're not going to, likely not to continue with that, because that's what the market is saying. It's going to be NVIDIA. So then as NVIDIA comes in to the integrated GPU market, combining their GPU with Intel x86, he started to bring AI into the PC market, and that is the moment we've been waiting for. And I think that's what we do. And I think the Qualcomm DNA is anything that is battery power, is high performance, low battery life, and a lot of AI. That's where we want the market to be.
So Cristiano, sell us on this moment, because I think a lot of people's experience with AI so far has been LLMs, and LLMs that you can use on your phone, LLMs that you can use in a browser. So if that's the way they are experiencing AI, why will they think that they need to buy a computer that is specialized for AI?
Okay, so this is a little different, and I wish I have time to walk you through all the details. Maybe that's an invitation for you all to come here, I think, next year.
We'll be there.
Okay, and, we're done. We'll come.
Yes, but I'll give you some very simple data points. The first thing is we used to learn how to interact. We had to learn how to interact with your phone, interact with PC. But now with AI, whether it's what we say, what we write, what we see, the computer knows how to interact with us. So the user interface is changing, and the user interface actually runs where the human is. It runs on your phone. It runs on your PC. So we're starting to see right now, and you see Microsoft doing that with the agents. You see that Google doing that with the agents. Then now the computer has this agent ready to interact with you as your assistant as you do things. That's the first thing that is happening. The second thing that is happening is there is incredible amount of processing power that is available. And as companies starting to see AI getting scale, because now it's about not just creating AI in the data center, I need to deploy it, I need to make money. They realize that you can leverage all of this computer. It's transparent to you. It's the wrong thing to talk about AI is cloud or is edge. It doesn't work like that. Just take it, for example, if you're Office 365 customer, you have cloud and you have a client. And AI is going to be deployed like that. And companies are saying, if I bring this to the edge, my cost goes down, my latency improves, and I have privacy. And that's what we demonstrated. Many ISVs starting to deploy AI on PCs and in phones.
All right, going to leave it there. Glad we could get that time with you and really cover a lot of ground. Cristiano, thank you so much. Enjoy Maui. We certainly wish we were there. It's a pretty great day here in New York City. Cristiano Amon, he is CEO and president of Qualcomm from the Snapdragon Summit in Hawaii, along with BTech co-host Ed Ludlow in San Francisco. Check him out every day with Caroline Hyde there on Bloomberg Television at 11 a.m. Wall Street time. And be sure to check out Ed's reporting out on this story.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, buy now, pay later is everywhere every day, as it feels like. You've got companies like Affirm, Afterpay, and Klarna. They've all brought installment payments into everyday life, while big banks and tech firms are also now racing, Tim, into the space.
We talked about the growth and growing competition recently with the founder and CEO of Affirm, Max Levchin. He joined us just a couple of weeks ago. Shares of Affirm, by the way, they're on a tear, up 30% year to date. The company provides a window into the consumer and health of our financial system. So when we were given the opportunity to talk with another key member of the C-suite, we certainly jumped on that. We got Rob O'Hare with us. He's CFO of Affirm. He was featured in a recent edition of the Bloomberg CFO Briefing newsletter. He joins us from San Francisco. By the way, sign up for that newsletter, bloomberg.com/CFO-briefing. Also with us is Nina Trentman. She is Bloomberg News Senior Editor. She writes the Bloomberg CFO Briefing newsletter. She's here in the studio. Rob, that's exactly where I want to start with you. How the consumer is doing. It's a question we posed to Max a few weeks ago, but you guys have real-time data. You're seeing at every moment how people not just are spending money, but how they are with paying it back. How's the consumer in the U.S. doing?
Well, first of all, thanks for having me. In terms of the consumer data that we see, we see a consumer that's strong and healthy. You know, we're originating, over $100 million of loans every day, and right now, all of the repayment data that we see in our daily loan cohorts, it's all really strong and it's exactly in line with our expectations. So that tells us that the consumer's healthy, and that tells us that we're setting the right underwriting posture in our business.
Rob, how about delinquencies in the business? Are those ticking up? What are you seeing there in the data?
No, I mean, we manage credit. That really is job one internally for us, and we stare at delinquency data. That's part of the repayment data that I was alluding to, and we're seeing outcomes that are exactly in line with what we would expect.
Just wondering, with the Fed cutting interest rates last week and indicating that there might be more cuts to come, how important do you think that is for your consumers, and also how important is it for your business?
It may be helpful for consumers, right? It may reduce the consumer's total costs of credit, which I think is beneficial for them. For us, though, we actually like the rate environment that we're in today. We're very profitable as a business. When we look at loans on a unit level, we're sort of at or above our long-term ranges. So we feel good about this rate environment. If rates were to go down from here, it might be a modest benefit for us. Not all of our funding that we utilize is floating rate in nature, so there could be a lag effect to see any sort of real material benefit. But I think one of the great things about Affirm is that we can be adaptable and we can excel in any macro environment.
One thing we want to ask you about is that Bloomberg Intelligence, our own research team, Rob, has put out a report this morning, and they're projecting that Affirm will surpass 30% growth this year, to ahead of consensus. So just talk to us, if you will, about some of the drivers here when it comes to volume drivers.
Sure. I think it's important to remember that our outlook for fiscal 26, we have a June fiscal year, we've established a minimum GMV for the year. So we don't have a range out there. There's no high end to that estimate. So certainly we put out a minimum number for GMV we would hope to achieve that, just given that it is what we think a floor for the business. Closer to home, for Q1, we're guiding that we see about 37% growth in the GMV line in the September quarter, and that would be down from the 43% that we had in the June quarter. So both metrics, I think, are quite healthy and quite strong, and we really like what we're seeing in the business today.
Hey, very briefly, can you just tell us a little bit about the Affirm card? 10% of your users are on the card. Tell us exactly how it works and the profitability on the card's portfolio. Is it better than conventional buy now, pay later?
Our card is slightly better profitability than our business at large. That really stems from the fact that the Affirm card is a repeat usage product. Most of our consumers come to us through one of our merchant integrations and then look to deepen the relationship with Affirm through some of our direct-to-consumer products like Affirm Card. So there's a lot to like about Affirm Card, both for us, but for consumers too. It puts all of the utility, all of the financing and flexibility that we offer through Affirm, it puts it on a card, and it allows consumers to transact in places that today Affirm doesn't have quite the level of coverage that we have on e-commerce. So we see a lot of usage for Affirm Card in store, in brick and mortar situations. And you can also utilize Affirm Card quickly and easily at merchants where they don't have an Affirm integration yet.
Rob, we're unfortunately running out of time. Maybe just 30 seconds just about the growth in your space. We've seen Klarna recently go public. And how far is that potentially boosting even attention to the space?
We think it's good for investors to have multiple providers in the space so that they can compare and contrast across us and Klarna. I would say our space has been competitive for several years now. We really haven't seen a change in competitive intensity. So, we're focused on driving our objectives, and right now the business looks incredibly strong from our perspective.
All right, gonna leave it there. Rob, thank you so much. Rob O'Hare, Chief Financial Officer of Affirm, featured in a recent Bloomberg CFO briefing newsletter. A new one, by the way, out on Sunday. Find it at bloomberg.com/CFO briefing. And of course, always our thanks to Nina Trentman. She's Bloomberg News Senior Editor.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Jillian Wolfe is back with us. She's Bloomberg Intelligence Global Equity Strategist. She joins us here in the Bloomberg Interactive Brokers studio. Jillian, we are off our worst levels of the day, but we were down as much as 1% at the lows on the S&P 500 at one point today. Why some selling? I mean, look, stocks go up and stocks go down, right. But are there any fundamentals here that you are watching about why we've seen shares of the S&P 500 down for 3 days in a row?
I think it's interesting that the S&P 500 is down, particularly right after this Fed cut, right? That was supposed to give a big amount of juice to the equity market, right? And now there's a lot of thoughts about, well, how many cuts can the Fed really do if we're running into some hotter inflation going forward? I think one of the things that differentiates the U.S. economy right now from a lot of others right now across the globe is that CPIs have been accelerating over the past few months in the U.S., and they've broadly been flat to stable elsewhere in the world. So we're not really in the same 2022 scenario where inflation was just hot everywhere and investors didn't really have a choice but to invest in an area where inflation was getting hotter. Now it's really kind of becoming a U.S. issue, and that's bringing into question a lot of what the Fed really will be able to do. And I think that's why we're seeing a little bit of weakness now.
Speaking of the Fed, Fed's Lisa Cook warning, of course, the Fed governor, Lisa Cook warning the Supreme Court of market chaos if she's fired. She has made a filing to the Supreme Court in a bid to save her job. We know that President Trump has taken it to the Supreme Court in order to remove her from the Federal Reserve. So the back and forth continues. Do you agree that if indeed Lisa Cook is out, what would that mean potentially for the equity side of things?
I think it would definitely be a destabilizing force for equities, right? There's a reliance in the investor community that the Fed can act independently of whoever the president is or whatever is happening.
And that to you would be a clear sign of the Fed is independent anymore.
Correct. If there starts to be
independent, yeah,
exactly. If there starts to be pressure about who can or cannot sit on the Fed committee as a result of their choices, it's a sign that there's less Fed independence, which regardless of whether you think that there should or shouldn't be less independence as an individual, it would destabilize equity markets. Because
what does destabilize mean? Down 10%, down 20%, down 50%?
It depends. I wouldn't make a call to say, oh, well, it'd be down 10 or 30% or something like that. But I think it casts a lot of doubt into the Fed's ability to keep inflation under control. And then that would ultimately bleed through into the market, right? So if the Fed isn't allowed to control inflation and fulfill its mandate, trying to keep unemployment low and keep inflation low as well, ultimately the stock market will respond if those forces start to get out of control.
We haven't seen even a reaction. We haven't seen a big reaction from the bond market or the stock market that shows that this is a real risk right now, at least to investors.
I think there's just so much uncertainty with this administration in particular. I mean, Trump was going to fire Powell at one point, and that didn't end up happening. I think we're in this very much wait and see mode to see if any of this actually goes through. The market, I don't think, is pricing that in right now, to be honest, which is a little bit dangerous because we are at all-time highs. And if there starts to be a signal that the Fed is losing some of its dependence, that could really rock the market from this very high place. That said, who's to say whether or not this actually happens? I think it's very difficult for anyone to really make that call right now, given the amount of volatility that we see in this administration.
All right. So Jefferies Financial, I can't remember who was on with us, says actually that's like the first sign of, kind of the beginning of earnings. And we'll start to get an idea, certainly from a financial market perspective. They report after market September 29th. And then, of course, we get JP Morgan, which is the big one that we always focus on. And that comes October 14th. But earnings, what can you tell us about expectations?
Eric Weiner told us that.
That's who it was, Eric. Because I was like, it was
Jefferies. It took me 30 seconds to remember.
But he said, because we were saying JP Morgan, in a couple of weeks. He's like, actually, Jefferies comes before that. And we will get that after the close on September 29th. What are we expecting for earnings this go around?
I think 2Q was such a big beat. I think earnings are in a little bit of a precarious place right now, right? Because 2Q, we had this massive beat. The tariffs really didn't flow through to earnings in as negative of a way as many people expected. There was this pause. Analysts made a lot of cuts heading into the second quarter. Turns out they didn't really have that much of an impact. But we're finding on earnings calls quite a bit, our CEOs and C-suites saying, we can manage this. We have inventory stock in place. We're hedging our bets against tariffs. I think there is a lot of expectation right now from investors that companies are actually going to be managing this tariff situation and this new tariff regime relatively smoothly, and any cracks that start to emerge in the earnings picture could be quite dangerous.
When you say relatively smoothly, what does that mean? Like put some pressure on margins?
Put pressures on margins, because right now we're not seeing it putting pressure on margins too much. A lot of companies stocked up early in advance of this, and a lot of companies are saying that they're coming to their own independent deals and they have their own supply chains, and things have been relatively smooth sailing thus far. I think it's setting up a bit of this, maybe a very high bar for earnings to clear in the next few quarters, because now C-suites have really given this impression of, we got this is not going to be that bad. And if it turns out that cost pressures really start to go up and start to eat into margins, I think because the market isn't expecting it right now, that's why the market's at new all-time highs, it could really be a bit dangerous.
No, I think about the conversation that we had with Chris Nicholas, president and CEO of Sam's Club yesterday, right? When he talked about, Walmart and all of its universe has incredible leverage with their supply chain. We know that. We talk about their ability to do that. But he did say that because of, I guess, that supply chain, the relationship with their suppliers, that they can go back and kind of figure this out with higher tariff costs, or figure out ways to maybe cut costs elsewhere, so that they don't necessarily have to raise prices to consumers.
What the discussion has really been about. We run a natural language processing sentiment model on our team. It's a fancy way of saying we run all the transcripts, earnings transcripts, through an algorithm that tells us how positive or negative the C-suite sounds about certain topics. Around tariffs, they still sound pretty positive. They're really hedging their bets, and I think we have to temper our expectations that maybe this won't be the worst case scenario for tariffs that we thought was going to happen back in April and May. We're not going to see this huge implosion of margins into the end of the year. But I think the risks are being downplayed a little bit right now of, this is smooth sailing, this shouldn't be any problem for us, which is what we're seeing on these calls. And there really is a risk heading into 2026 that it starts to weigh down on their costs.
I wouldn't be surprised if executives don't want to say that because they don't want to draw attention.
They don't. But it's setting up a risky place, keeping the market this high, that the second you get even a little bit of disappointment on that, that's really going to have an exacerbated effect now, because we're expecting things to run so smoothly.
We're living in a fear factor moment. That's kind of how I see it. It's kind of interesting. But I also talked about this with Mark Gurman when it comes to Apple and fiduciary responsibilities, right, of a CEO of a publicly held companies in maybe keeping their companies off the radar, right? I don't know.
Yeah, I mean, you don't want to sound the alarm bells if you're in the C-suite. Your job is, particularly in these earnings calls, is to talk about how you're going to manage the tariff regime. You don't want to say the world's on fire and this is terrible.
All right, Jillian, thank you so much. Jillian Wolf, she's Bloomberg Intelligence Global Equity Strategist, joining us in our Bloomberg Interactive Broker studio. This is Bloomberg.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.